Well, good morning, everyone. It's 10 o'clock, so we'll dispense with the formalities and call the June 8th, 2023 meeting of the Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of May 11th, 2023. Have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. We have 4 items, but prior to having a vote on those items, Louise is here to give us our annual actuarial valuation report as of 12/31/22. Good morning.
Thank you, Mr. Chairman. Good morning, everyone. Can everyone hear me okay? Thank you.
Yeah, we're good.
It's good to be here this morning on this beautiful Thursday here in Oklahoma City. And it's great to have this opportunity to present the results of our work. And for the purpose of my presentation this morning, it will be the results of the December 31st, 2022 actuarial valuation of the pension plan. So the actuary's job is to measure the liabilities of the plan and then compare those liabilities to the assets held in trust. And based on that comparison, we can determine a contribution a city contribution that is sufficient that when coupled with future levels of investment income will be sufficient to fund the obligations of the benefits promised to city employees who participate in this plan. One of the main findings of our work is shown on page A as in Apple -2. So we do our calculations as of December 31st, 2022. That's the last day of the pension plan year. These contributions apply to the city's fiscal 2025 budget year. So the year beginning July 1st, 2024, ending June 30th, 2025. That lag enables the city to plan or budget for the contribution requirements. It's a fairly common practice among public funds. You see lots of numbers on the page. Actuaries like numbers. We like showing things in a lot of detail. You know, I realize after more than 30 years that not everyone shares our enthusiasm for the details. I'll focus just on the bottom chart, the city contribution. Employees, of course, also make contributions to this plan. So the contributions are expressed as percentages of plan member pay. So the finance folks, Brent's staff, they will take these contribution rates and they'll apply it to pay during the appropriate budget year. And the city makes contributions to the fund on that basis, which is a really good way of making the contributions because you're applying it to actual payroll. Some systems will use a dollar contribution based on projected pay, but I think what the city's doing is very appropriate. You can see that the contribution rate has increased over the prior year. And the reason for that, there are 2 reasons for that. One is the investment performance during 2022, but probably the bigger reason relates to pay increases among the employees covered by this plan. And the financial information for the plan is shown on page B as in boy -3 of your report. So this page is an excerpt of the financial statements for the pension plan. And so it's shown on a calendar year basis. You see 2022, and then for comparison, calendar year 2021. So you see contributions made by employee members of the plan, as well as city contributions. And then you see the investment income shown in item C. interest and dividends. The number in brackets is negative, so it means the value of securities held in trust decreased during 2022. Now, this is fairly common. I don't think I work for a pension plan where this has not happened. A fairly common occurrence. Everyone suffered in terms of investments in 2022. But you also see refunds of member contributions. Employees contribute to this plan. If they quit and they're not eligible for benefits, they get a refund of contributions. The benefits paid also increased over the prior year, over $44 million. Your pension plan population is growing as baby boomers make their way through your system. And then you see administrative and investment expenses. So the number at the bottom in brackets, 168, 169 million, that's the decrease in the value of assets during calendar year 2022. And at the bottom of the page, we have kind of a thumbnail sketch of how plan assets are invested. Jason could certainly provide more detail. The rate of return on assets on a market value basis was a negative 14.8% for the year. But if you go to page B4, the next page, we have a lot of numbers here. So when we develop the city's contribution and the system's funding percent, we don't use just the market value of assets. Doing that would create a great deal of volatility in city contributions because capital markets are volatile. And so instead, we smooth the investment gains and losses that occur over time, over a 4-year period. And so as a result, you get what are called valuation assets or the funding value of assets. This is a it's a very common method used by public funds. And again, the goal is really to reduce contribution volatility. So without delving into a lot of detail, which we find interesting, but again, we recognize not everyone does, you can see the market value items B and C at the beginning and end of the year in the column titled 2022. Item E shows the investment return for the year. That's a negative 143 million, less investment in administrative expenses. Item E2 shows what we expected the fund to earn based on our long-term return assumption of 7% net of expenses. And so it's that difference, you subtract one from the other, a negative 203 million that's getting phased in over a 4-year period. And that's shown in item F. So although the returns for 2022 were not great, they were pretty bad, you had great experience over the prior 3 years. You had over a 14% return last year on assets. The return for 2020 was over 15%, and the return for 2019 was over 17%. So we're not recognizing all of the gains and losses in any one year. We're recognizing 25% of those. So although 2022 was a bad year for investments, it's offset by the favorable experience that you had in the prior years. And so as a result, the investment losses, they had an impact, but it wasn't huge in terms of what it did to the contribution requirements. So what this means, though, because 2022 you had investment losses, is that we'll be phasing in over 103 million in investment losses over the next 3 years. And you can kind of see that looking at columns 2023, 2024, and 2025. So in 2023, 17.8 million in losses will get phased in, plus whatever happens in 2023, which is not known. 2024, you'll have a negative 34 million in losses. 2025, another 50 million in losses coupled with the investment experience for those years. So the smooth value of assets, because you have losses that haven't been recognized, it's inflated relative to market value. The other factor affecting your plan is shown on page B-8, balloon-8 of your report. And that relates to the pay experience for employee members of the plan. And so you see this historical chart of employee members of your plan. Inactive members are people that have quit and deferred receipt of pension benefits. You see annual payroll for the system as a whole. And then in the far right column, the percent increase or decrease in employee member pay. And so this year, the average increase was 8%. And, my thanks to Regina for tracking down the reasons for this, which include things like contract settlements and other overtime promotions. And so the benefits of your plan are pay-related. And so when you have an increase that's high, it increases our assessment of benefits that are going to be paid in the future, which in turn drives up our assessment of liabilities and then the corresponding increase in city contributions. But you can see, just looking at that last column, that your pay history, there's some volatility here. Back in 2020, you had some large pay increases too, probably pandemic related, as I recall. But you see in many years, the pay increases are relatively modest. So that was probably the bigger reason for the change in city contributions to the plan. And, we're seeing that in other plans as well. It's becoming increasingly difficult to attract and retain public employees.
I have a question. When we have, sometimes our COLAs for our employees don't occur until the beginning of the next calendar year, and you're dropping, your line is December 31st on this report. So does that come into play? Because when you're doing that, you're looking at the actual expenses, not what's really been obligated. If we haven't finalized an agreement and the retro hasn't occurred, it hasn't hit the system, so therefore it's somewhat understated, our liability then.
Right.
Is that correct?
Potentially, yes. So if you have an agreement pending for calendar year 2023 where you've agreed to, and I'm just going to make up an example, give everyone a fixed $2,000 increase or something, or $5,000 increase as a retention bonus or something, it's not reported in the pays in this report. That's correct. I think if we had a clear understanding of that, we could have included it in this report, which would help stabilize contributions. It would probably raise it even higher.
Because I was thinking maybe, I don't recall the 8.9% increase in 20, but I was thinking there may be in a timing situation where it might have hit, two pay increases may have happened in the first part of 20 and the second part of 20 was for the next fiscal year, and the timing of that. So that probably weighs into the situation.
Right. I guess the other issue would be whether those increases are a permanent part of someone's annual salary as opposed to being a lump sum one-time payment. If it's a one-time payment, I think it would be appropriate to exclude it from the work we're doing because we're trying to capture someone's pay at retirement.
Right.
And if it's going to exclude the lump sum payment, then we're overstating pay.
Right.
Just anecdotally, I remember 2020, we had the hiring freeze due to the pandemic, and so there was an extraordinary amount of overtime that we had to account for.
Any other questions before we move on? Okay. On page D, like David, -1, we have a brief history of the system's assets, liabilities, funded ratio, and unfunded liability or funding surplus. And so just looking at the column titled funded ratio, what you can see is that it's hovering around 100%, in many years exceeding it. So the funded ratio is a common metric used by many to assess the financial position of the fund. It's not the only metric, but it's a common and important one. So it's the ratio of assets to liabilities. So in 2022, your funded percent was over 101%. So it means for every dollar of liability, you have $1.01 of assets, which is a great position to be in. There are a lot of funds that would like to be in this position, but are not. And you can also see the value of assets and the value of liabilities as well. So the assets exceed the liabilities. So as of December 31st, 2022, the plan had what we call a funding surplus of over $12 million. And you can see when you compare it to 2021 that it's decreased. And this is driven largely by the experience of the plan. I suspect, but I don't know, in 2023, I would not be surprised if you no longer had a surplus and that your funded percent dropped below 100. I mean, it's not going to plummet to 70 or something, but I suspect it'll drop below 100%. It'll depend in large part on the investment performance during 2023 and payroll as well. And on page A-5 of your report, there are some additional comments as well.
A5.
So each year we prepare for the system and the city an accounting report. It's pursuant to what are called GASB Statements 67 and 68. That stands for Governmental Accounting Standards. All municipalities and statewide systems are required to follow these standards. And the purpose is to produce actuarial information that shows up not only on the retirement systems, ACFR financial report, but also the citywide report. And there are going to be differences between that information and what's shown in this report. So one of the key findings are the liabilities, assets, and funding percent. But for accounting purposes, the city's budget year is July 1st to June 30. This report is a calendar year basis, so the numbers are not going to match. So in the city's financial report, their financial statements, it's going to show a lower funding percent for a couple of reasons. One is the value of assets as market value, as Brent well knows, during 2022. Here we're using a smooth value, so there will be differences. This report also reflects the liabilities associated with the stipend payment. Basically, it was paid out of surplus. And finally, there's another note that you as a board and a city should be aware of. As actuaries, we're bound by what are called actuarial standards of practice. And there was a revision to these standards recently. It will affect all public employee pension plans. It creates a duty for us to report obligations on what's called the LD-ROM, a low obligation default. Let me make sure I got this right, low default risk obligation measure. So basically, the idea is to measure the liabilities of the plan as if you were invested in low risk assets like treasuries, high quality corporate bonds. And there are a couple of schools of thought about what this does. One is that it's yet another attack on public employee retirement systems. Because if you were invested in treasuries, for example, our assessment of liabilities would be huge because the relationship between the investment return assumption and liabilities is that it's inversely proportional. The lower the discount rate, the higher the assessment of liabilities because we think you're getting less investment income in the future. So one school of thought is this is just another attack on public funds because everyone's plan is going to look so much worse. The other perspective is it gives decision makers like this board and the city a sense of the investment risk that you're taking on. And public funds are they commonly have diversified portfolios, which is why you can justify higher rates of investment return than what you would get in treasuries. But it just gives you a sense of the risk, the investment risk that you're taking. And it's the biggest risk that you have as a pension plan, the investment risk. You know, to the extent that you're not meeting your investment targets, it creates higher contributions for the city because you need investment income to pay for the benefits of this fund. But, you know, overall, good news to report, and I'm happy to answer any questions that the board may have.
Questions for Louise? Louise, I just want to say thank you. You and your firm continue to do an excellent job for us, and we are so appreciative of everything you do for this, you know, this board. So
Thank you so much,
Thank you
Mr.
again.
Chairman.
with that, Chair will entertain a motion on item number 3, the consent docket. Have a motion and a second. Please record your vote. Item is approved. Moving right along, item number 4 is to ratify approvals. We have several items. We can take those with one motion. Have a motion and a second. Please record your vote. Item is approved. Item number 5 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item number 6 on our agenda is to approve the following applications for service retirement. We have a motion and a second. Please record your vote. Item is approved. Item number 7 is to receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. I have a motion and a second. Please record your vote.
I think we're on the wrong item.
No, I think I said the wrong item. No, I didn't.
No, we skipped 7.
Did we skip 7? Well, anyway, item 8 passes.
Okay.
All right. Let's go back. No. We did item 6, which was the applications for retirement. That was approved.
But 8 has the vote on it, 7 doesn't. Look on my screen. But now she's got 7 up.
Okay, so again, I need a motion and a second on item 7 to receive report of death and authorize payment of $5,000 death benefit. Motion and a second. Please record your vote. Item is approved. Now, do I have to go to item 8?
Do you want to redo 8 or just?
Yeah, I mean, let's do item 8.
Let's redo it.
Item 8 is to receive report of death, authorize payment of the 5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item 8 is approved again. Item number 9, receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 10 is to approve request of the following to terminate vested rights and receive a lump sum distribution of his employee contribution account. I have a motion and a second. Please record your vote. Item is approved. Item number 11 on our agenda is item 11A is approve sending attendees to the Oklahoma Public Funds Trustee Educational Conference, September 27th through September 29th, 2023 in Durant, Oklahoma. Have a motion and a second. Please record your vote. Item is approved. Item number 11B is the fiscal year 23-24 Oklahoma City Employee Retirement System budget. Virginia, you want to give us a high-level overview of this?
Good morning, Chairman and trustees. For your consideration is the fiscal year '24 budget, just over $53 million. It's a 10% increase over the prior year, with the increase in pension payments accounting for the majority of the increase. Couple of things I just wanted to point out. I've had a couple of you reach out regarding the increase in accounting services, so this is related to item B and C. Just a reminder that OCERS now has a dedicated municipal accountant, and last year, Finance asked OCERS to shore up those costs for that person. We were paying 75% last year of their fully loaded salary, and now it's phased in fully. So that's also reflected on item C. A couple of new small purchases that I've talked to the chairman about. We're working towards doing a storage and scan on demand for some of our old records. So that's just a separate, very small item. And then we're also been quoted at a couple of Surface tablets so that all three of us will have tablets if we need to work remotely. But those purchases will be coming at future board meetings. I just wanted to point them out to you that they are in the budget. With that, I'd be happy to answer any questions you may have, though.
Any questions on item 11B for Regina? Hearing none, Chair will entertain a motion. I have a motion and a second. Please record your vote. Item is approved. Item number 11C is the agreement between the Oklahoma City Employee Retirement System and the City of Oklahoma City regarding the city's obligation to provide certain professional and non-professional services and office rental to the Oklahoma City ERS, and for the ERS to provide certain professional services for the city. Fee of $205,086.97 for July 1st, 23 through June 30th, 24. Any questions on this item? This is just a routine item that we do every year. Hearing none, Chair will entertain a motion. I have a motion and a second. Please record your vote. Item is approved. Item 11D is the Administrative Services Agreement with the Oklahoma City Deferred Compensation Board and the City of Oklahoma City to provide administration of the 457 deferred compensation plans and the money purchase plan and trust number 8751 and number 7697, period of July 1, 23 through June 30th, 24, revenue of $44,000.
Yes.
Regina.
So as many of you may remember, we had an ordinance last fall where we created a completely separate OKC Deferred Compensation Board, and that board has met a couple of times. And last week, they became a party to this agreement because we thought that would be appropriate, and last week they approved this agreement. I do want to just give you a heads up that that board also approved an RFP for investment consultant services for those plans, and that is expected to go to the next council meeting. Once we have an idea of costs for those services, we expect an amendment to this agreement. So I just want to give you a heads up that at some point we will have an amendment for this contract because those services for the investment consultant will flow through this contract. But I do have any questions?
And I think it's fair to say that next week, Regina and I are meeting with the budget director to discuss the possibility of an additional position in the retirement office now that we have a separate board for the 457 deferred compensation plans, which means a whole separate agenda and a extensive amount of additional work for the ERS office. So I just want to let everybody know that that may be forthcoming in the future where we get approved for another ERS position, which the 457 board will pay for. So that's just FYI. So any other questions? Hearing none, we'll entertain a motion on item 11D. Have a motion and a second. Record your vote. Item is approved. Item 11E is the actuarial services agreement with Gabriel Roeder Smith and Company to provide actuarial consulting services for the annual evaluation through the period of December 31st, 2025. Any questions? Chair will entertain a motion and a second. Record your vote. Item is approved. Item number 12 is to receive the investment consultant report. Good morning, Jason.
Morning. Jumped the gun there for a second. Just all we have this morning is the ASAP. I always like to make comments just to remind everybody about the long-term nature of the asset allocation and the investment program. As Louise pointed out, from an actuarial standpoint and a funding standpoint, you use a 4-year smoothing, so you have the very good years of 19, 20, and 2021 to help offset what happens in 2022. And we recognize that in how you've developed your asset allocation and your investment program overall. We know that not every year you're going to get 7% or 7.5%. We know that there's about a 20% probability that in any given year, not just next year, but any given year, you could be flat to negative. The results in 2022 certainly was a difficult year in markets with interest rates going up and valuations coming down. I'd say based on our forward-looking expectations, that was about a 90 percentile event. It could have been a little bit worse, which we certainly saw in 2008. That was about 10% worse than what we saw in 2022. That said, that set us up as we came into this year. We talked about we revisited the asset allocation and our expectations going forward. And when I say going forward, I don't mean the next 6 months or next year. We're talking about the next 10 years, the next 20 years. We're in a better position because interest rates are higher. Treasury rates are in the close to 4% range, and valuations were down from historical highs. That said, where we sit today, really most equity asset classes are about in line with historical averages. U.S. large cap still slightly above, and I'm going to talk about that a little bit more in a minute. Small cap stocks do look a little bit more attractive from a valuation standpoint, as does international. If we look at go back one page. This market overview, I think this is interesting. I mean, we can, I intentionally talked about long-term and asset allocation because I can come in here month after month and talk about things that move the market in the short term, and we know there are things. The debt ceiling last month weighed heavy on markets for the month, and certainly what the impact to the Fed, where are they going to go from here? Are they going to raise rates? Are they going to pause? Eventually, we're going to see rates go down again at some point, but probably go up a little bit more from here. That's all in the short term. The debt ceiling, kind of political news on the side, it somehow miraculously got resolved, and thank goodness, because it helped stabilize the markets. That said, if we look at what's really been going on this year on the left side there, the light blue bars are year-to-date returns. So this is the first 5 months. And you see the S&P 500, that's a pretty strong return, up 9.6% for the year, for the first 5 months of the year. EFI, which is international markets, up about 7.2% for the year. Everything else is really flat. Small cap stocks are flat, actually down a bit in the month. So they're fairly valued right now. Emerging markets are slightly positive. Bonds, investment grade bonds as measured by the AG, up 2.5%. But as we look at your portfolio results, we're lagging the policy benchmark a bit, which a good portion of the policy benchmark is the S&P 500. It represents your large cap, which is a 20% target. It represents the long short, and it represents private equity. So it's not a complete one apples for apples comparison in the short term. Over the long term, we think it's a good proxy. Your large cap, and I've been talking about this a lot the last several months, is roughly 50-50 split between the SSGA, S&P 500 passive cap-weighted index fund, which has kept up. It's done what the index fund has done. The other component of that is the Intech strategy, which is a benchmark risk-controlled strategy. It is measured against the Russell 1000. That's their opportunity set, not the S&P 500, which is another large cap benchmark. Historically, over long periods of time, those two benchmarks track each other pretty closely. But just as you can tell from the names themselves, the Russell 1000, 500 more stocks, it goes down a little bit lower in market cap than the S&P 500. And the Intech strategy is not weighting based on capitalization. It weights based on mathematical volatility capture strategy. If you look over here on the right side of the page, this is what the headwind recently and really over the last couple years has been for this Intech strategy. On this right side of the page, where the bullet there, tech performance drives S&P 500 year-to-date gains. This has really been going on for some time. It also drove the decline last year, but it also drove the returns over the last several years in 19, 20, and 21. What you see there, 7 stocks out of the 500, Apple, Microsoft, NVIDIA, Google, Amazon, Meta, or formerly Facebook, and Tesla. Those 7 stocks make up 22% of the entire index capitalization. So the other 493 stocks make up the balance of 78%. In the quarter, or year to date, I'm sorry, those stocks have been 100% of that 9.6% return. Those stocks, those are the contribution, the Apple 2.2% of the 9.6, Microsoft 2.1% of the 9.6, and so on. The other 493 stocks are actually down on average 40 basis points. So that just shows the very narrow breadth in the market, where headline is the S&P 500's up almost 10%. That's really 7 stocks, and that's really been a headwind. So as we look at your portfolio results, and if you go 2 more pages, I'm sorry, 1 more. So if you look right here, you really see that in these year-to-date numbers for large cap. Your overall large cap net of fees is up a little under 8%, 7.95, where the benchmark is up 9.65. SSGA is up 9.6%, that three basis points relative to the benchmark. That's fees. There's fees in the index fund, whereas the Intech strategy is up 6.73%. It's not cap weighted. It's going down smaller cap, and that having simply not having the weighting in those 7 stocks has been a headwind, and that's been pretty trying for the last several years, as some of those mega cap names have really, mega cap tech names have really dominated. That's something we continue to look at. I do think it's potentially something we want to cover. I'd say we haven't had Intech in a while. It might be worth having them in just to talk about, but it's not broken. It's just this is what's happening in the market. Overall, your small cap is done okay. On a year-to-date basis, down about 65 basis points, 91 basis points net of fees. It's about in line with the market. Private equity, you're seeing marks flowing through in private equity where you're having some declines on the year. Might go back 1 page, I'm sorry, Regina, to the asset, sub-asset class. Nope, forward 1, I'm sorry. There we go. You see there, private equity and long short really offsetting one another. The long short has really bounced back. This was an area that we had talked about. We made some tweaks to this. We've made some redemptions and rebalancing there, but really from the middle of last year forward, really had seen a rebound there, up about 5%. So on a relative basis, it's actually, it's on a 1-year basis, it's your best performing asset class. It's outperforming the S&P 500, which is up about 3% over the last year. Small caps down 5.3. International is up 3.6, the benchmark. So your long short equity is your best performing asset class over the last year. Private equity, as I mentioned, these valuations are catching up. We're seeing some write-downs in portfolio companies really catching up to what happened in the public markets last year. Non-US, a little bit behind. A lot of that was the Lazard strategy, which is really more of a core non-US developed with a slight value bias in 2022. Really, the deeper value you were, the more energy you owned early in the year, that was really a driver, and they're more high quality focused, don't own a lot of energy and oil, which was pretty prevalent, what we saw in a lot of non-US managers, not expecting the impact of the Russia invasion of Ukraine, which really drove up energy prices, so lagged a bit there. Fixed income overall, slightly down, but now on a year-to-date basis, you've got about a 2.5% return from fixed income. As I said, where we sit today, much better place than where we had been. We're seeing yields, 10-year yield kind of trading between 3.5 and 3.8 right now, after moving up closer to 4.5% middle of last year. Still have an inverted yield curve with the Fed funds rate at about 5% right now, but we're starting to see that discrepancy between 2-year and 10-year Treasury yields narrow a bit, as market observers are expecting somewhat of a slowdown in the economy and intermediate to longer term rates coming down. Real estate, we did see the second consecutive quarter of negative returns. We're seeing those flow through into portfolios, not surprisingly. Morgan Stanley, the Prime Property Fund, you're down. This also includes some of your private real estate as well, down about 1.5% on a net of fee basis. However, the benchmark, blended benchmark down almost 4. And then cash, while you don't hold a lot of cash, actually getting a decent return there. On a one-year basis, it's a very small amount, and that's it fluctuates from month to month based on benefit payments and us raising cash for benefit payment needs, but it's your second best performing asset over the last year. So I think, understanding what's driving the market and really the narrowness of breadth in the S&P 500, while the 10% return looks good, it's pretty limited to a handful of names right now. As Louise said, this year, where we end up 2023, don't really know. We don't expect it to be as bad as 2022. Right now, you're 5 months in and you're at about 3.25%. We could see equities selling off a little bit and bonds hopefully holding up. If that happens, yields come down and bonds give you a little bit more cushion than they have in the past. But overall, no specific issues other than the Intech that I mentioned. With respect to the conference, just want to let everybody know the agenda is coming together well. I think we have every spot on the agenda filled. It'll be a good Louise is participating and on the actuary session. Cindy Burley on legal, and we got a number of a couple of new speakers that we haven't had before. Still working on maybe moving some things around, but it's all coming together well. So.
Great. Any questions for Jason this morning?
With so much of S&P weighted on those top seven, do you feel like the S&P is on shaky ground?
I don't know that I could say that it's on shaky ground or not. I mean, longer term.
I mean,
Again,
not long term.
Our view is always strategic, Sri. So in our view, it's still very difficult for active large cap managers, which would be one way to deviate from that, to add significant value over time net of fees. And that's why our feeling is being passive is a better approach. That said, you do have some things in place. Your large cap allocation has come from closer to 35% down to 20% by adding active management in other asset classes, long short equity, private equity, increasing small cap and increasing non-US, which is all very active. So that diversification really is intended to mitigate some of that risk and some of that concentration risk in the top heavy part of the S&P, but I don't know that it would, certainly having 7 names drive return, there's probably some risk there.
As much as the allocation to small and mids hasn't really played out yet for this year to date, moving forward, I mean, that's the expectation, right, is that small and mids outperform large.
That's our expectation.
Thank you.
Any other questions? Thank you, sir. Chair will entertain a motion to receive the investment consultant report.
I got logged out.
I have a motion and a second. Please record your vote.
I'm going to have to vote manually.
Okay.
Yes, please.
Kim, you vote aye.
Item is approved. Item number 13 is comments from board, staff, and citizens. I've just got a couple things. Regina has sent out the registration information for the conference. I know we're still a very few months away, but if you could get that in as soon as possible, that will help immensely. With regard to 2 vacant seats, as you saw in the election results, the former budget director for the city, Doug Dowler, has been elected to serve out the remaining year of Mr. Lawson's term that became available when he retired. And the ASME position will no longer be filled by Jackie, although we haven't received a formal resignation yet. We're looking to fill that with another union member at some point in the very near future. So, anything else for the good of the cause?
Yes, and congratulations for you getting re-voted in. That's good. Good deal.
Thank you. Thank you very much. With that, we are adjourned at 10:51. Thank you, everyone.